Question 816. Sam conveys a life estate to his son, John, for the life of his other son, David. John marries Sandy, then John dies a year later. The estate goes to A. Sandy, John's wife, because she is the heir of the life estate holder. B. Sam, John's father, because the person to whom he conveyed the estate has died. C. David, John's other son, because he is the measuring life for the life estate. D. Because a death has occurred, a judge in probate court must decide. Correct answer is A. Sandy, John's wife, because she is the heir of the life estate holder. Grantor, Sam. Life tenant, John, the person who holds the life estate. Measuring life, or pure autre vie, David, the life by which the duration of the estate is measured. The crucial element here is that the life estate is for the life of his other son, David. This means the estate's duration is tied to David's lifespan, not John's. John marries Sandy. This is a personal event and doesn't change the nature or duration of the life estate. John dies a year later. Since John is the life tenant, but David is the measuring life, the life estate does not terminate upon John's death. The estate continues as long as David is alive. Since the life estate is still in effect, because David is still alive, John's interest in the life estate will pass to his heirs. This type of life estate, pure autre vie, is inheritable by the life tenant's heirs if the life tenant dies before the measuring life. When John dies, his interest in the life estate, which is for David's life, passes to his heirs, which in this case would be his wife, Sandy, as a primary heir. She will hold the life estate for the remainder of David's life. Sam, the grantor, only gets the property back, or it goes to a designated remainderman, once David, the measuring life, dies. John's death does not revert the estate to Sam. David is merely the measuring stick for the duration of the estate. He doesn't automatically receive the estate upon John's death. While probate might be involved in distributing John's estate, including his interest in the life estate, the rule of law dictates who inherits the life estate, not a discretionary decision by a judge. The judge would apply the law of wills, intestate succession to determine John's heir to the life estate. Therefore, the estate goes to John's heir, Sandy, to hold for the remainder of David's life. Question 817. The penalty for paying off a Calvet loan in less than 3 years is A. $500. B. 4 months worth of interest. C. 1% of the loan amount. D. None of the above. Correct answer is D. None of the above. Calvet loans, offered by the California Department of Veterans Affairs, are known for their favorable terms and benefits for eligible veterans. One significant benefit consistently highlighted in their program information is the absence of prepayment penalties. According to Calvet's official website and other resources, there is no prepayment penalty fee for paying off a Calvet home loan early. Question 818. Which of the following would be considered non-recurring closing costs in the sale of a property? A. Title insurance. B. Appraisal. C. Natural hazard disclosure. D. All of the above. Correct answer is D. All of the above. In real estate, closing costs are typically categorized as either recurring or non-recurring. Non-recurring closing costs are one-time fees and expenses paid at closing that are associated with the transaction itself and will not be paid again. Recurring closing costs are ongoing expenses that begin at closing and continue to be paid periodically, e.g., monthly, annually, such as property taxes, homeowners insurance premiums, and WA dues. Title insurance is a single premium paid at closing. It protects the buyer, owner's policy, or the lender, lender's policy, from future claims. These claims usually stem from title defects that existed before the property's ownership transferred. It is a non-recurring cost. The appraisal fee is paid once to determine the market value of the property for the lender's purposes. It is a non-recurring cost. Natural Hazard Disclosure Report, required in California, discloses if a property is in certain natural hazard zones, e.g., earthquake fault zones, flood zones. The fee for this report is paid once at closing. It is a non-recurring cost. Question 819. The release clause in a trust deed is used to release a. some properties upon partial payment, if more than one property is used as security for the debt. b. the escrow company from liability. c. the borrower from liability. d. the seller from liability. Correct answer is a. some properties upon partial payment, if more than one property is used as security for the debt. A. release clause, in a trust deed, or mortgage, is a provision that allows specific portions of the collateral to be freed from the lien of the trust deed under certain conditions. The most common context for release clause is in a blanket mortgage or trust deed, which covers multiple properties, e.g., in a subdivision. When a developer sells individual lots, the release clause allows a portion of the loan to be paid. This action then frees that specific property from the overall lien. This way, the new buyer gets a clear title. The release clause in a trust deed deals with the collateral for the loan, not the liability of an escrow company. Paying off a full loan frees the borrower from all liability for that debt. In contrast, a release clause only allows specific collateral to be released after a partial payment. It doesn't eliminate the borrower's overall liability for the remaining loan balance. The borrower remains liable for the remaining balance on the properties still covered by the lien. Question 820. Sam, a California real estate broker, has a prospective purchaser referred to him by a broker from Nevada. After a sale to that buyer is transacted, Sam wants to split his commission with the Nevada broker. According to the real estate law, Sam may a. not split a commission with an out-of-state broker, b. split a commission with an out-of-state broker, but only if the sale occurred within 1 month after the client referral occurred. C. split a commission with the out-of-state broker, d. split a commission with an out-of-state broker, if Sam, the California broker, retains 2/3 of the proceeds. Correct answer is C. split a commission with the out-of-state broker. Under California real estate law, a California licensed real estate broker is allowed to split a commission with an out-of-state broker. The key condition for this is that the out-of-state broker must not perform any acts requiring a real estate license within California. The Nevada broker is allowed to refer a client to Sam. However, all activities requiring a real estate license for the California sale must be performed solely by Sam, the California licensed broker. This includes tasks such as showing properties, negotiating terms, or preparing transaction documents. California Business and Professions Code Section 10137 allows a California broker to share commissions with out-of-state brokers. This is permissible as long as the out-of-state broker did not perform any licensed real estate activities within California. Question 821. Buyer Bruce purchases a home from owner Orville, paying in cash. However, there is a mortgage loan attached to the home, which Orville is still paying off. Given these circumstances, what kind of deed will probably be recorded after Bruce's purchase from Orville? A. deed of reconveyance to buyer Bruce. B. trust deed against buyer Bruce. C. deed of reconveyance to owner Orville. D. bill of sale to buyer Bruce. Correct answer is C. deed of reconveyance to owner Orville. When Bruce purchases the home for cash, the existing mortgage loan on the property, owed by Orville, must typically be paid off at the close of escrow. This is done to ensure Bruce receives clear title, free of Orville's prior debt. Once Orville's mortgage loan is fully paid, the lender, or trustee, in states using deeds of trust like California, is legally obligated to release the lien on the property. The document that accomplishes this is a deed of reconveyance. This deed formally removes the mortgage or deed of trust from the public record, confirming that the debt has been satisfied. The deed of reconveyance is recorded in favor of the original borrower, Orville, demonstrating that his obligation has been fulfilled and the lien against the property he owned is cleared. Question 822. The cost of a capital improvement and its impact on market value are: A. Never similar, B. Always similar, C. Usually similar, D. Rarely similar. Correct answer is D. Rarely similar. While capital improvements can increase the value of a property, the cost of the improvement and the resulting increase in market value are not always proportional. Several factors can influence this relationship, including 1. Location. Improvements in desirable neighborhoods may have a greater impact on value than improvements in less desirable areas. 2. Market conditions. The overall real estate market can affect how much value an improvement adds to a property. 3. Quality of the improvement. Higher quality improvements are more likely to increase value significantly. 4. Cost of the improvement. The cost of the improvement itself is a factor, but it's not the sole determinant of increased value. In many cases, the cost of a capital improvement may exceed the increase in market value it generates. This is because the market may not fully appreciate the value of the improvement or because there may be other factors limiting the property's overall value. Therefore, it's important to carefully consider the potential return on investment before making significant capital improvements to a property. Question 823. John inherits a house from his late Aunt Jane. Mindful of John's past problems with the police, Jane inserts a condition in the bequest that should John ever be arrested, title to the house will revert to a charitable organization. John's property interest is A. Life estate, B. Fee simple defeasible estate, C. An estate in fee, D. Tenancy at will. Correct answer is B. Fee simple defeasible estate. Tenancy at will is a landlord-tenant relationship where either party can terminate the tenancy at any time without notice. It's a very weak form of possession and has nothing to do with inheritable ownership like a fee simple. A life estate is an interest in real property that lasts for the duration of a person's life. While the interest is not absolute, the condition described, reverting upon arrest, is not typically how a standard life estate operates. A. Fee simple estate is the highest and most complete form of ownership. However, a defeasible or qualified fee simple means that the estate is subject to a condition. If that condition occurs, or fails to occur, the estate can be terminated. Specifically, this sounds like a fee simple determinable or a fee simple subject to condition subsequent. In a fee simple determinable, the estate automatically terminates upon the occurrence of the stated event, e.g., so long as, until, while. In a fee simple subject to condition subsequent, the grantor, or their heirs, designees, has the option to terminate the estate upon the occurrence of the stated event, e.g., provided that, on condition that, but if. Regardless of the precise subtype, the core idea is that John has ownership, fee simple, but it can be defeated or lost if the condition, being arrested, is met, causing it to revert. An estate in fee is a very broad term for fee simple ownership. While technically true that it's a type of fee estate, it doesn't specify the defeasible aspect, which is critical here. An estate in fee could also refer to a simple fee absolute, which has no such conditions. Question 824. When a homestead exemption has been filed by a debtor who is 65 or older, the property is exempt from judgment liens up to A. $50,000, B. $100,000, C. $175,000, D. The homestead exemption was discontinued by federal law in 2010. Correct answer is C. $175,000. The homestead exemption in California protects a certain amount of equity in a person's primary residence from being seized by creditors to satisfy a judgment. The amount of this exemption can vary based on factors like age, disability, and income. As of recent changes, the homestead exemption amounts in California are $175,000 for individuals who are 65 years or older, are disabled, or 55 years or older with a gross annual income not exceeding specific limits. $100,000 for a family unit. $75,000 for all other homeowners. However, it's important to note that effective January 1, 2021, California law significantly changed the homestead exemption amount. It is now the greater of $300,000 or the median home price in the county, not to exceed $600,000. It is now the greater of $300,000 or the median home price in the county, not to exceed $600,000. This change was made by AB 1885. Correct answer is C. $175,000. This suggests the question might be referencing an older version of the California homestead exemption law or a specific context. For the most current information, it's always best to refer to the latest California statutes. If the question is from a context that predates the 2021 change, then $175,000 would be correct for the specified category. Prior to January 1, 2021, the homestead exemption in California for a debtor who was 65 or older, or disabled, or certain low-income individuals, was indeed $175,000. However, it's important to note for current context that as of January 1, 2021, California's homestead exemption law significantly changed. The amount is now generally the greater of $300,000 or the countywide median sale price for a single-family home in the prior calendar year, not to exceed $600,000, which has been adjusted for inflation since then, now higher than $600,000. But based on the question and the provided correct answer, it refers to the law before that 2021 change. Question 825. The concept of rescission means that a contract is A. Altered, B. Filed with the court, C. Cancelled, D. Incorrect. Correct answer is C. Cancelled. Rescission means that a contract is terminated or cancelled. Both parties agree to rescind the contract, which essentially undoes the agreement and returns them to their original positions before the contract was formed. It makes the contract null and void from its inception.